The most alarming market development in 2025 so far is that US government bonds and the US dollar fell at the same time as US equities. This upends their long-standing role as safe havens. So why is this happening? What are the safer investments in this new environment? And will the US regain its safe haven status? Today's video is sponsored by Trading 212, a UK commission-free investment platform. Now cast your minds back all the way to November of 2024, and journalists were talking about things like TINA. There is no alternative to the United States. If you look at this graph of MSCI USA, which is just US stocks, it's tearing ahead the rest of the developed world. So that would be the MSCI World Index excluding the US. Why would you ever consider investing in any other market? Well, fast forward to 2025 and everything seems to be reversed. What we see this year is that MSCI World ex-USA is outperforming MSCI USA. The US is massively underperforming the rest of the world. Now, when it comes to risky assets like equities, you can see the reasons why. Because of the very severe tariffs that President Trump has imposed, that's very likely, in the opinion of markets at least, to erode US corporate earnings and subsequently push down US equity prices. So you'd expect political risk to be priced into US assets, in particular US equities. But I think what's much more shocking is if you look at US safe assets, so that would be things like US Treasuries, these are government bonds issued by the US government, those have almost always been safe havens. It's very unusual to see those selling off at the same time as equity sell-off. That's because when people are scared, they run back to what they consider to be safest, which is usually US Treasuries. Furthermore, you'd also expect to see the US dollar, which is also considered a safe haven, rally relative to other currencies. Now we'll come back to the dollar later, but now let's hear what Jerome Powell, Fed Reserve Chair, has to say about this.
So we've seen volatility also in the bond market, and at a time when usually there's a flight to safety, we saw yields on the German Bund and the Japanese government bond come down, but we saw yields on US Treasuries go up.
Now remember that when yields go up, prices go down. So when US Treasury yields have gone up, it's because US Treasuries are falling in price. And the shocking thing here is that Japanese government bonds and German bunds did act as safe havens, while Treasuries didn't.
So I would just say the same thing. I think it's very hard to know in real time. I've had a lot of experience with significant moves, for example, in the bond market, where there's a narrative that people land on, and then 2 months later you look back and go, that was completely wrong. So I think it's very premature to say exactly what's going on. Clearly, there's some delevering going on among hedge funds in levered trades and things like that. It's also, again, it's the markets processing historically unique developments and with great uncertainty. And I think you'll probably see continued volatility.
So what's going on here? We've got things which are usually safe, the US dollar, US Treasuries, selling off with risky assets. Is the US no longer a safe haven? But before we dig into what happened with Treasuries and the dollar, I'd like to talk about Trading 212's ISA. And today's video is sponsored by Trading 212. I've been using Trading 212 stocks and shares ISA for a few years, and I love the platform. Here's why. Firstly, it charges no account fees or any monthly or annual subscription fees. Secondly, it offers a lot of choice for my fund portfolio, which is what I have on Trading 212. Trading 212 offers over 13,000 ETFs and stocks from the UK, US, Canada and Europe. And finally, it leads the way with new functionality all the time. The product managers and software engineers at Trading 212 are always busy on our behalf. For example, it offers fractional shares, pies and auto investment features bundled into their ISA. If I had to choose my favorite feature, it would probably be pies, where you can create portfolios within your ISA. I've got lots of ideas for my fund portfolio, and pies let me track those ideas and also monitor them separately. For example, I've got a UK small cap pie, a copper miner pie, a European defence stock pie, all within my Trading 212 ISA. If I want to rebalance any of those pies, I can do it with just one click. You can fund your pie using regular investing via direct debit, and that encourages regular saving. You can also reinvest any dividends back into the pie automatically. And if you're scratching your head deciding what to include in your pie, there are lots of popular portfolios and portfolios created by professional fund managers. If you don't like the risk involved in buying stocks, then Trading 212 also offers a cash ISA. This offers a market-leading rate, currently a 4.35% variable rate as I make this video. Furthermore, Trading 212 charges no account fees whatsoever on their cash ISA. Your interest is earned daily and paid monthly. The cash ISA is also flexible, which means that within a tax year, you can withdraw cash and put it back into the account without affecting your ISA allowance. Your money is kept in a segregated account and protected by the Financial Services Compensation Scheme up to a value of £85,000. Now, as a PensionCraft viewer, you get a special offer from Trading 212 where you can claim free fractional shares worth up to £100. Just open an account, verify it, fund it, and then use my name as the promo code, which is RAMIN, RAMIN, and you'll find a link to that offer in the description below. Now let's look at what happened with that Treasury sell-off. So here you can see QQQ, which tracks the Nasdaq 100, which is a tech-heavy US stock index, and that's the black line, and you can see the response of equities in the US to the announcement of Liberation Day, which was a very widespread set of tariffs against many countries across the world from the US. Now, it wasn't particularly surprising to see that stocks fell very rapidly after that announcement. And for 2 days, if we look at an ETF that holds US Treasuries, long duration US Treasuries, so this is the TLT ETF, that held up pretty well. But notice what happens on 7th of April. Treasuries started falling, not slowly, but rapidly. Yields went up and prices went down, and that happened for 3 successive days. And eventually, President Trump blinked. He had to roll back many of the reciprocal tariffs, and many people think it was due to this huge sell-off in the US Treasury market. Far from being seen as a safe haven, they were seen as being risky, and that was a huge reordering of the state of the world. You can also see that the recovery of US Treasuries wasn't as significant as the recovery of equities. The interviewer mentioned that Japanese government bonds and German government bonds, or bunds, rallied at the same time that US Treasuries were falling. So it wasn't those markets which lost their safe haven status. This was something specific to the US. Now, what this graph shows is the total return, so that's the capital gain plus income, on German bunds and US Treasuries. Notice how they tend to track one another. It's often the case that developed market yields do that. However, there was a huge disconnect when the German government announced that it was going to remove its debt brake. That means that it was going to spend more money and not worry too much about balancing its budget. Now, that led to a sell-off in German bunds, whereas US Treasuries weren't affected. But then look at the effect of Liberation Day. What we see is the opposite. US Treasuries were tanking at the same time as bunds were rallying. And if we looked at Japanese government bonds, or JGBs, those also rallied during this period. Now, there are many theories about what's going on here, and I'm going to list just some of them, going from most likely to least likely, although the truth is it's probably a combination of these things. The first one is that bond investors were simply pricing in political risk and the risk of higher inflation in the United States. Remember that bonds hate inflation. It's like kryptonite for bonds. So tariff-induced inflation would have been toxic, and yields rose and prices fell. The second explanation, which many people use, is something called a basis trade being unwound. Now, what is the basis trade? Well, this is a very common hedge fund strategy where you can essentially do an arbitrage between bonds bought today and bonds delivered, say, 1 month from now in the futures market. Because effectively you're buying and selling the same thing, they should have roughly the same price. If there is a price difference, you can buy one, sell the other, and then pocket the difference. Now, because the differences aren't usually very large between treasuries and treasury futures, you leverage the trade. You borrow money to invest, And that's what introduces a lot of risk to what would normally be considered safe. Now, if there's lots of volatility in the Treasury market, what usually happens is that there are margin calls and the hedge funds have to sell assets, usually treasuries because they're liquid, in order to pay for that margin. And they'll probably be unwinding these levered trades at the same time. So what you'd expect to see is a very rapid unwinding of these trades and selling of treasuries, which pushes prices down and pushes yields up further. So this amplifies market moves when they're very sharp. Now we're getting onto the more tenuous explanations, in my opinion, and the one I don't really buy is that countries like China are selling their US Treasury holdings. It is true that about a third of US Treasuries are held by foreigners, and China's holdings are very large, just under $800 billion, but it's unlikely they're going to do this. Because if they did sell their treasuries, where would they park their dollars? In cash? That would probably earn less interest. And while they have been gradually running down their treasury holdings, they haven't been selling them rapidly as far as we know, at least not yet. And then finally, the least likely explanation, I think, is the Mar-a-Lago Accord. Some people say that as part of this plan, the US government will ask politely foreign government holders of its government bonds to swap those coupon-paying bonds with a fixed duration for effectively perpetual bonds or bonds with a century maturity with no coupon at all. Now, strictly speaking, extending the maturity of government debt is a default. But if you ask nicely and it's done voluntarily, that's not a default. However, I suspect that if markets saw this happening and being imposed on foreign bondholders, the Treasury market would go into freefall. Hopefully that's not something which the Trump administration is seriously considering. Another shocking thing was the fact that the dollar sold off as well. So if we look at a trade-weighted currency index for the US dollar, this weights the strength of the dollar versus its largest trading partners. Look at how much that fell during this period. And what's surprising here is that interest rates were rising during this period. Normally one of the big drivers of the dollar is higher interest rates relative to the rest of the world. So if rates rise in the US, you'd expect that to strengthen the dollar. But of course, at the same time as we had the Treasury sell-off, yields were rising and we saw the dollar fall at the same time, which makes this dollar fall all the more shocking. I think that becomes even clearer if you look at this model from Standard Chartered. What they tried to do was to build in risk appetite or fear as well as interest rate differentials and try to predict where the US dollar should be based on those variables. And you can see the US dollar trades pretty much in line with that model until we got to this huge sell-off. There's a massive disconnect between the fall in risk appetite and rising interest rates in the US and how the dollar behaved. So what we observed over this big sell-off period was unprecedented. Furthermore, it was very worrying. Now, I've had people ask me, what can I buy that's safe now that US Treasuries are falling? So let's look to see what held up. So from a UK investor's perspective, here I can show you the life strategy funds during this sell-off period. Now, what did work was having UK government bonds and global government bonds as part of your hedge. If we look at Life Strategy 100, which is pure equity, that sold off much more than Life Strategy 20, which is only 20% equity, 80% global government bonds, including US government bonds, it has to be said. So a global bond fund would have protected you against this sell-off. The lines you can see at the top of this graph, which are very smooth, are UK money market funds, and I've only shown 3 of them here, but you can see that they tend to generate very similar returns. Now those were rock steady through this big sell-off, as you'd expect. They have almost no duration risk, very little credit risk, and they're almost cash-like. So global bonds worked as a hedge and UK money market funds worked as a hedge. And it has to be said US money market funds would have worked as well. But the real star of the show here was gold. So if we look at this PHGP fund, which is a physical gold fund from Wisdom Tree, you can see that that was up about 9.3% in sterling terms. The money market funds just earned the UK SONIA rate, which is what they do. That's roughly bank rate from the Bank of England. And if we look at a passive UK Treasury fund from Vanguard, that's VGVA, you can see that that also held up pretty well. There was more volatility compared to the money market funds because there's duration risk, but it didn't crash like US Treasuries. And the final shock and blow to UK investors was that the US dollar didn't rally during this equity market sell-off. Now that usually cushions the blow for UK investors because when we convert it back into pounds, the sell-off isn't as large if the dollar rallies. Well, this time around, the dollar fell, US equity fell, and because a global index fund contains about 65% US stocks, you got the double blow, currency and equities falling. So to answer the question of what's safe, money market funds, UK government bonds, also if you held single gilts to maturity, very safe. And of course in this case, gold did very well indeed. So we have to ask the question, is this just a one-off, or will the US eventually return to being a safe haven? And I think the answer really depends on what happens to US politics. Will this regime of uncertainty continue? And I think the answer, certainly over this presidency, is likely to be yes. So I'd expect that markets would remain cautious about the US. It won't regain its safe haven status until the political uncertainty and of course the trade policy uncertainty starts to abate. That's really the source of the volatility and the lack of trust in US safe haven status. So to summarise, there are still lots of assets which act as safe havens. If you're a UK investor, I really wouldn't panic. And as Jerome Powell said, the sell-off in treasuries is still orderly. It's not the kind of chaotic tumble of all markets that we saw during the COVID sell-off, for example. If that were to happen, remember, the Fed stepped in, particularly in the treasury market. But I think it is shocking that markets which I always considered would be safe forever have suddenly lost their safe haven status. Now don't forget our offer from Trading 212. You can claim free fractional shares worth up to £100. Just open an account, verify it, fund it, and use my name as the promo code, which is Ramin, R-A-M-I-N, and you'll find a link to that offer in the description below. And, as always, thank you for listening.